What if there was a way that you could know exactly how much home you could afford and you wouldn't have to worry about whether you could afford this house or not afford this house? Well, in today's video, I'm going to share with you exactly how to know what you can afford using the math calculation that lenders like myself use whenever they determine how much home you can be pre-approved for. So if you're interested in that, stay tuned. Now, this math calculation gets overcomplicated, but it is something that lenders use. They don't just come up with your pre-approval amount out of thin air. It's not magic. It is actually math, and it's called your debt to income ratio, or DTI. You may have heard it abbreviated by a loan officer who didn't explain it. And so what a debt to income ratio is, it's a very simple calculation. It is your monthly debts divided into your gross monthly income, leaves us with a percentage. That percentage is your debt to income ratio. So what you want to do is first calculate what your monthly debts are. And so we're going to do that by looking at the items that are on your credit report, as well as additional items that may not be on your credit report, such as child support payments, alimony payments, those types of things. And so what we do is we take all of the monthly minimum payments on your credit cards, all of the monthly payments from your auto loans. If you have student loans, and they're deferred, we're typically going to take 0.5% of the balance of your student loans and make that the monthly payment. And so I know that may be confusing, but even your student loans get calculated, even if they're deferred. And so we take all of those monthly payments together, okay? And I'm going to pull up a calculator here. And we'll put something on the screen. But let's just say that you have a $350 a month car payment. Your minimum monthly credit card payments are $100 a month. And then let's say that you have another $200 in debt. Okay, so that could be from student loans. It could be from anything. That's going to give you $650 total in your monthly debt. All right. Now, let's say that you make $60,000 a year salary. To keep this easy, that's $5,000 a month. So if I take your $650 and then I divide that into your $5,000 a month gross monthly income, that is a 13% debt to income ratio. That's very low. However, we have to include your mortgage payment in your debt to income ratio. So when it comes to that, let's say that your monthly mortgage payment is $1,500 a month. And then we add the $650 a month in debt you already have, that's $2,150. Now when we take that $2,150 and we divide it into your $5,000 a month gross income, we're left with 43% DTI. Now at a 43% DTI, you would likely qualify for most loan programs out there. When it comes to DTI, which is debt to income ratio, there are actually two different ratios. What we just calculated is the back end ratio. It's the one that gets all the glory. It's the one most people know about. Your back end debt to income ratio is the amount of your monthly debts and your mortgage payment divided into your gross monthly income. There is a second calculation called the front end debt to income ratio. Back end, front end. Your front end debt to income ratio is your mortgage payment divided into your monthly gross income. And this is a ratio just designed to make sure that your mortgage payment isn't too much on its own for your current mortgage that you're trying to get. So in this example, the mortgage payment was $1,500 a month and your gross monthly income was $5,000. That left us with a 30% front end debt to income ratio. So your front end was 30, your back end was 43. Both of those numbers would pass everything for the most part. Now, USDA, sometimes they tend to be a little more restrictive, but we'll jump into that. And so those are the two numbers that the lender is going to look at in order to determine what you qualify for. Now, when you get a pre-approval letter, it shows you pre-approved for a dollar amount, right? Like your pre-approval is for $250,000. But what you're really pre-approved for is not an amount, it's a payment. And so there could be two identical houses in different locations, one and in the same price, but one might be more than the other, right? If the insurance comes back more expensive, let's say you take a house and you put it on the Gulf Coast, and that same other house is in the middle of the country, in the Midwest. Both $250, both the same. The one in the Midwest may be cheaper than the one on the Gulf Coast because the insurance might be cheaper, right? that affects the mortgage payment. So when we pre-approve you, what we're pre-approving you for is a monthly payment, and that monthly payment is based on a couple of factors. One of them, or the monthly payment that you qualify, is based on a few different factors, one of them being your debt to income ratio. So when it comes to saying, hey, you're pre-approved for $250,000, one of those things is making sure that at that $250,000, you meet the debt to income requirements. So the other thing would be your down payment, making sure that you have enough to cover the closing costs. When it comes to conventional loans, you're typically capped at a 45% back end debt to income ratio, and you generally around 30 to 35 front income ratio. Now there are certain instances, if you have high credit and other compensating factors, where you may be able to go up to 50% debt to income ratio or 49.99 on a conventional loan. With FHA, you can generally go to a 41% front end ratio and a back end ratio as high as 56.9%. Now, not everyone's going to get that. If you have low credit or you don't have a down payment or you're getting gift funds, it could adjust that. So we like to say 50% with FHA, you're pretty safe. Anything over that, it's going to be on a case-by-case basis. On USDA, the front end ratio is 29%. The back end ratio is 43%. Like the other programs, there's a little wiggle room there for folks with higher credit scores or more assets or different things like that. But as a general rule, 29.43. If you're a manual underwrite, it's actually 29.41. So that's the debt to income ratio, and it does have an effect on what you're pre-approved for. Now, if you have a high debt to income ratio, there's only two ways to fix it, right? Because the same formula, the same numbers that get put in have to change in order to make that go up or down. So you can either increase your income or decrease your debts or decrease your mortgage payment. Those are going to be the only ways to make your debt to income ratio come down. The lower your ratio, the easier time you're going to be approved. But as long as you meet each loan program's specific guidelines, you're typically going to be okay. So if you've got a 76% debt to income ratio, your only options are add more income or pay off more debt, right? Either one of those two. Now, sometimes people add more income by adding a second borrower. Now, remember though, their debts also have to come into play. But sometimes you can do that. If you're doing a conventional loan or an FHA loan, you can have non-occupying co-borrowers. So mom or dad or a family member can step in and add their name to the loan, give you more income to help you qualify. But on the other loan programs, it's generally only the people that are going to live in the home. So, but that is one way of adding more income. The other is obviously pay raises, different job, things like that. Or just paying off debt, right? Like you can pay off your car, you can pay off your credit cards. You can do different things like that in order to bring that debt to income ratio down. And those are conversations that we would always have with our clients. Like, hey, if you're close, we'll try to figure out a way to get you under. If you're really far away, like 75% or 80%, it may take some time and some effort to get things where they need to be. But that's it. That's how lenders determine what you qualify for. It is predominantly driven by your monthly debts and your gross monthly income. And so the higher your monthly income, the lower your monthly debts, typically the more you're going to be able to qualify for, right? Now, if you meet the debt to income requirements, but you don't have $10,000 to put down or $9,000 to put down if it's FHA on a $300,000 house, then you may only qualify for $200,000 because your down payment is limiting you. But most of the time, it's debt to income that comes into play than your down payment amount or your closing cost amount. So anyways, that's a quick explanation of debt to income ratio. I hope that helps you. If you liked this video, please like this video and subscribe to the channel so you never miss a video just like this. And hey, drop me a comment. Did you understand this? Let me know what you thought about debt to income ratio. I love to hear from you guys.